You're watching today's market comment here at XM.com by Mario Sachigiriakos. I'm Christina Marujos. An unexpectedly soft U.S. employment report could not hold down the U.S. dollar on Friday. While non-farm payrolls slightly exceeded forecasts in August, revisions showed that employment growth in July and June was much weaker than previously reported. Wage growth moderated as well, solidifying market expectations that the Federal Reserve will forego raising interest rates this month. The U.S. dollar and yields initially got knocked down, but once the dust settled, long-dated Treasury yields stormed higher again, which translated into dollar strength. Looking ahead, the outlook for the dollar seems increasingly favorable. The American economy is already in better shape than the Eurozone's, and the recent spike in energy prices could further exacerbate this divergence, hitting euro-dollar in terms of growth differentials and trade flows. Hence, the only missing ingredient for a full-scale U.S. dollar rally might be a period of risk aversion in equity markets. Meanwhile, in China, a series of targeted stimulus measures seem to have finally done the trick in restoring some confidence among investors. Beijing stepped up its support for households and property developers last week by announcing tax breaks for childcare and education spending, while also relaxing restrictions on home purchases. Even though all the stimulus announcements so far appear to be half measures, the fact that the list is growing larger every week has started to fuel hopes that Chinese economic activity could begin to bottom out soon. This cautious optimism was reflected in commodity markets last week, with industrial metals and energy prices staging a furious rally. Oil prices hit their highest level since November as the prospect of an improvement in demand tipped the scales in a market where major producers have been closing the supply taps for some time now. Gold prices displayed striking resilience on Friday, managing to close the session almost flat despite the spike higher in real yields. There might be an element of gold getting caught up in the broader China-fueled commodity rally, or perhaps sovereign purchases by central banks continue to underpin demand. Either way, it's encouraging that bullion has not fallen victim to the latest bond and FX market moves. That said, there is still much work to be done before the technical picture turns positive again. Thank you for watching today's market comment at XM.com. Have a great week.